Jeff, Zach, thanks for joining me.
What's going on,
Hey,
Steve?
Steve, thanks for having us.
Hey, interest rates are going on and they're going down. So, want to talk to you guys a little bit about that. We've seen mortgage rates climb most of last year, reaching almost 8%. We haven't seen that in a couple decades. But lately they've been heading down. We've got a chart right here of the 30-year Treasury rate, which is fairly correlated to mortgage rates. And we can see here after breaching the 30-year Treasury, breaching over 5%, correlated in time with those mortgage rates hitting almost 8. We're now trading close to around 4.15 after a breach in below 4%. And we've got a lot of experts expecting rates to fall further this year. So we want to talk a little bit, get you guys' thoughts on the mortgage rate environment. Some initial thoughts you guys have.
I would say it's strange, but for maybe the younger generations, I don't want to ban them indefinitely as just millennials. But for those people who are used to seeing 2-3% interest rates, that's extraordinary compared to historically where the 80s you saw 18%, 20%. Those are now considered usury rates, especially in Florida. Where I remember when I first started into the financial industry, prime itself was 12, 13%. Home interest rates were 9, 10%. This is while it's not great with the price of or the value of homes out there and having to buy them, it's probably sticker shock for some generations. It's not abnormal to see these rates, but it is nice to see them going down too. So I'll add that to it.
Yeah, and just to kind of add some color, I know we're going to be doing more educational type videos around these topics going forward.
Yep.
But we do have the Fed that sets the discount rate that's hovering around 5.5, and then that influences the Treasury rate, and then that influences the mortgage interest rate. But it's not a direct correlation. Another thing seeing here is the spread between that Treasury rate and the mortgage rate actually kind of widened. And what that means is that the mortgages were, in terms of how much more the Treasury rate, they're actually higher than historically normal. Some of that is due to the Fed not buying and other market participants not buying as many mortgage bonds as maybe they had in the past. Some of that is tightening lending requirements around mortgages. But we also have reason to think that that spread going forward, it already has started to shrink a bit. If it returns to historical averages, that would be a benefit. And then, of course, the Fed cutting rates, it controls the discount rate, the rate that banks can lend, which is a much lower rate. But it's been cutting rates, and that's partly predicated on the view that inflation's headed lower. That we haven't seen the inflation pressures, which is a topic all by itself. And I would also, and I think I agree with some Fed observers who think that the Fed a lot of times wants to help the guy who got them their job keep his job. So it's not unusual to see the Fed easing before a presidential election. I think that's we got a little bit of that going on here too, which is not a partisan comment. Republicans, Dems, these sort of things tend to happen. But I think there's a lot of reasons to expect that we will continue to see interest rates fall, mortgage rates come down, which will be a benefit to the economy. You guys can talk a little bit more about the price impact that'll have on commercial and residential housing, but we're probably not looking at a dramatic fall. No, nobody's really calling for that. But we are, most experts are foreseeing rates headed a bit lower, which should be positive.
Well,
Yeah, I
let
mean,
me
I
let me jump in. I haven't said anything yet.
go for it.
What's it really mean, right? That's kind of what people want to know. So let's use an example. When interest rates fall, the pricing on real estate assets changes. It's usually in commercial changes on what's called a cap rate. For those of you who are rusty or don't know what it is, like Steve said, we'll do some more content on that in the future, and we'll show you what a cap rate is and how to calculate it and how to use it. But a general rule of thumb in the commercial side is for every 1% that an interest rate moves, the cap rate will usually compress or expand by about the same margin. So, for example, right now there's a spread over the treasury rates. So the 30-year is 4%, for example, and we might see something like 2.5% over that. So if you take that 6.5% as a cap rate, for example, $100,000 asset, you divide by the 6.5%, it's worth about $1.54 million right now. Last year, that cap rate was much lower. And moving forward, if rates come down, say 1%, that cap rate probably comes in 1%. So what's that mean? That same $100,000 asset, you now divide by a 5.5% cap rate, and that value would be closer to 1.82 million. So by cutting rates 100 basis points, 1%, you're increasing the value of an asset, arguably or theoretically, $280,000. What that means is more money out the door, more lenders in the market, prices go up. You might be seeing a new bull market, at least in real estate, which would be interesting.
Yeah, I think an important point to add there too is it also takes some pressure off, right? I mean, we do have some folks out there that, maybe use some very aggressive pricing, or maybe some folks, I mean, we've certainly seen the issues with traditional shopping malls and the issues within some urban cores, especially some of the lower quality office products having challenges. If the rate you can now get capital are lower, it does help those financial models out. If the banks are more willing to lend, it helps those out. It takes a little bit pressure
Absolutely.
off. And so I do think we're looking at this as a positive for the sector, and taking some of that stress off and some of those troubled areas, which I don't want to overstate, because there's plenty of sectors and areas that are doing well. But there are definitely some problem areas, and having a lower financing cost definitely helps some of those operators out.
Well,
Yep.
you can add to it as well, just the side of losing the stress of potential event, or I should say the initial stress of the COVID impact, to office, to retail, et cetera, and how that might change. I think people have found that that's different. So, combined with the interest rates, that makes this makes it a little bit more feasible for banks to get comfortable to lend on product as well.
Yeah.
Okay, so I think a lot in this topic, as well as the category or topic of, is the Fed cutting too much? When's it cutting too much? And then if inflation starts to become an issue, a lot of things we can talk about. But I think the consensus here right now, among us, and especially among the people who follow this, is that rates are likely to be easing off for a bit. That's likely to be beneficial for real estate, residential, and the commercial sector. So starting off the year with some good news here in this case.
Yep.
All right. Thank you, gentlemen.
Thanks, Steve.